Good afternoon, everybody. Welcome to today's webinar. My name is Alec McCutcheon. I'm a director of Unicom, and we're very pleased to be hosting today's presentation, which is in association with our conference next month, AI, Machine Learning and Sentiment Analysis Applied to Finance. Today's theme is News and Social Media Analytics for Behavioral Market Mispricings. And our presenter is Elijah De Palma. Elijah is a quantitative research analyst for Thomson Reuters Machine Readable News Group. The webinar is going to run for about 45 minutes, and we'll have opportunity for questions at the end, so please feel free if you've got questions to type them in, and we'll try and answer as many as possible at the end. So I'm aware about a tight timescale, so without further ado, I am going to hand over to Elijah.
Hi, this is Elijah De Palma, speaking to you from the Thomson Reuters office in San Francisco. I joined the Thomson Reuters Machine Readable News Group 4 years ago and have been working to identify value in our news and now social media analytics signals relative to clients with a wide range of investment horizons. I deliver presentations regularly to high-frequency trader clients and market makers, as well as hedge funds looking for arbitrage opportunities over midterm horizons, as well as large AUM funds and pension funds who are looking for longer-term applications of news or social media signals. I have a few preliminaries to introduce you to the vocabulary I'll be describing before I get to the main bullet points. And I'll also highlight an application that I first was introduced to at a sentiment analytics conference in London, also hosted by Unicom, last July 2015. Part of my role at Thomson Reuters is to evaluate vendor partnerships, and we've considered a number of vendor partnerships with social media providers, many who've claimed to mine social media to identify predictive signals for finance applications, generally equities. In most all cases, I find there to be little predictive value from social media signals, and rather social media tends to be reactive after prices have already moved, at least at the higher time scales. However, the idea that was provided by Professor Asher Curtis at the Sentiment Analytics Conference last July in London is a fundamentally simple and novel way to utilize social media, and I've been applying it successfully at a range of investment horizons. I'll be introducing this idea in the preliminaries bullet point, and then working my way down to look at midterm strategies, and then the last two bullet points looking at longer-term applications over longer-term horizons. This slide shows trending research within the last couple of years using our Thomson Reuters Machine Readable News products, and I'll be highlighting two of those in the next slide. In the orange box, you can see news analytics, market psych indices, and we also maintain the news archive of our full text XML and XML format of the full text news that's distributed across our feeds, both Reuters news and our third-party providers, dating back to 1996. When I joined Thomson Reuters 4 years ago, the primary use case applications are those I've listed up top. As you would anticipate, we've seen news analytics signals applied for high-frequency trading purposes to identify signals in real time, and also for trade execution. The simple idea, as outlined in the white paper I have listed there, is that when there are strong positive sentiment signals, there generally is higher buy demand, and it's more difficult to execute buy orders, and vice versa. When there's negative signals, it becomes more difficult to execute sell orders. So throughout the trading day, you can time your execution strategy accounting for the news that's been breaking in real time within the last few hours. The second bullet point is stock selection. There was a number of research papers done by leading equity research teams at JP Morgan and Deutsche Bank using our news analytics product. And one thing they were looking at was daily sentiment signals, firm-specific, and how those might be used in a short-term trading strategy of only 1 to, say, 3 holding day period. Prior to 2010, we did see some IC decay, significant IC decay, into the future 1 to 3 days. However, in the last few years, markets have become more informationally efficient, and we now measure ICDK in hours and minutes. And a naive, simple application of sentiment signals, buy on positive sentiment, sell on negative sentiment, has no value over future 1, 2, or 3 day time horizons. Now that simple approach must be utilized at higher frequencies. However, there are more subtle approaches to utilizing the sentiment signals, as I'll be describing in this webinar. And lastly, commodities and energy topics. I've listed a couple papers there by leading academic researchers, Professor Svetlana Borovkova, who also consults for oil firms in Dubai, as well as Professor Lee Smollett, who's currently working with our Japanese language news analytics product, which is being released this quarter. And I'll describe that more in the next slide. Now, within the last year, we've seen an explosion of use cases to very different areas, either publications or working papers. Many of these are in leading journals, such as Journal of Portfolio Management and Journal of Financial Economics. We have papers utilizing our products for FX applications, for global macro, for example, tactical asset allocation, for policy around sovereign debt announcements. Interesting, the systemic risk, this is very new research. The academic group developing this research has looked at news analytics signals around systemically important financial institutions, or SIFIs, and constructed a systemic risk indicator from those. What's remarkable is their systemic risk indicator is qualitatively identical to the S-risk indicator developed by Professor Robert Engel, which utilizes firm fundamentals and capital shortfall. At the last point there, the supply chain economics, there's an idea being developed that journalists possess soft information regarding company relationships, and if they co-mention companies in news, there's likely a supply chain linkage between those companies or some peer-type relationship between them. In this slide, I'll introduce the two primary products that I work with, the News Analytics and Market Psych Indices products. On the left, the News Analytics in real time is scoring all of our Reuters news and also our third-party contributor news from major news wires and also stock exchanges. This is done in real time with latencies on the order of hundreds of milliseconds. On the right-hand side, Market Psych Indices is a third-party vendor that we have an exclusive partnership with. We've worked with them to productize their offering by providing them with point-in-time alias lists of company names, and we exclusively distribute their Market Psych Indices products. They're taking all of our Reuters news, but they're also scraping publicly available content from our competitors, such as Dow Jones and Associated Press. To understand the scale, all the Reuters news that we're providing them accounts for only 5 to 10% of all the news that's included in their aggregated news feed. Separately, they have a separate feed of aggregated social media content. A big subset of this comes from Twitter, a big subset from StockTwits, and they also have dozens of crawlers which are scraping hundreds of financial investment social media blogs. In terms of the entities in the analytics, with the News Analytics, we're providing company-specific sentiment scores. So if 3 companies are mentioned in a single Reuters news article, we'll provide 3 different sets of sentiment scores specific to that company. What's the author's tone towards the company in the news article? And that's scores independent of any associated price movement. There's no price data used to calibrate our News Analytics on the left. We're also providing sentiment scores on commodity and energy topics. And with our new version 4.0 release this quarter, we're now providing document-level sentiment scores over all news, not just corporate news, but political news, FX, Treasury news, etc. On the right-hand side, Market Psych Indices, they all are scoring companies globally, 8,000 plus companies. They're also looking at markets, so sector level, geographical level, market level scores, or company roll-ups, you could say. They're looking at country level scores over 140 different countries, currencies, and also commodity and energies. And all of their analytics is entity specific to the entity they're looking at, whether it's a company or a currency. They're not scoring individual news and providing a single score for you, the content, they're aggregating all the content they scrape in the up to the minute time period. That's the highest granularity they provide. And they update their feed minutely, and those scores can be aggregated to the hourly, daily, or even quarterly levels, as I'll demonstrate. Now, in terms of the analytics, on the left, the news analytics, we have state-of-the-art natural language processing. We have a team of computational linguists who are experts in developing text analytics in real time. The primary dimensions they're looking at are sentiment of the author towards the company, the relevance of the company towards a news item, and also novelty. How new or breaking is the news item relative to all news items that have been passed through our feeds within the last 12 hours, 1 day, all the way up to 7 days. On the right-hand side, MarketPsych, they're doing simpler bag of words type natural language processing. They have a predefined set of words and phrases, or word stems and phrase stems, that they're looking for in the content sources. And when they identify an entity, they look for words and phrases that are in linguistic proximity to that entity. The total volume of words and phrases they identify specific to an entity, specific to a company, is their buzz metric, and that's an important metric I'll be referring to later. That gives you a window on how much words and phrases are being discussed about a particular company or entity in a given minute time period. They also combine the volumes of words and phrases detected to construct emotional indices related to sentiment and fear. Also words and phrases related to events such as layoffs, mergers, social unrest in countries. And finally, macro level indices, words and phrases related to inflation, sanctions, and unemployment, etc. And there's dozens of different indices they've constructed from all the words and phrases that they're scanning for. Now, I will point out that all of our companies are identified by company perm ID. This is part of our Thomson Reuters strategic push across our entire enterprise to link all of our content sets together, not just in financial and risk, but also legal and tax and accounting content sets will all be linked using perm IDs. And there's perm IDs for people, officers and directors, individual deals. In this case, we're using the perm IDs for companies to uniquely point-in-time identify the company being discussed in the news or social media. The big takeaway from this slide is that with news analytics on the left, you have very precise sentiment scores, and you have granularity where you can filter to the individual news item. On the right, with MarketPsych, you don't have the ability to filter to the individual news item. However, you do have a large breadth of content. MarketPsych is scoring a vast array of news content as well as social media content. In this slide, this is part of my preliminary slide where I'll be introducing an important point. I'm looking at pre-market news in the U.S. on Russell 1000 from 6 to 9 a.m. and how that affects the price gap at the market open. And if you look in the box on the far right, daily volume, that shows the total volume relative to the trailing 21-day average. The black line in the middle shows when there's no pre-market news as identified by either MarketPsych, which is aggregated news, or our news analytics. And I'm tracking the buy and hold abnormal return as of yesterday's trading day at 12 noon, all the way through today's open at 9:30 and through the close of today at 4 p.m. When we see a positive MarketPsych news sentiment signal, this is the aggregated news sources, we now get a bump up at market open of around 20 bips, abnormal return, and a bump down from negative sentiment signals of around minus 20 bips. And if you look to the right, you see there's about a 20 to 30% increase in trading volume, most of that happening during the first few hours of market open. When we use our news analytics product, we can now filter to the relevant breaking Reuters news. So we can eliminate much of the noise from the aggregated feed, and we get a much stronger signal. Now we're seeing that when we have the filtered Reuters news, we're getting a bump up of around 100 bips at market open, or a bump down of minus 100 bips for either positive or negative news sentiment stories, respectively. And if you look at the numbers for the aggregate positive news, that's around 46,000 signals over this 2.5-year period. When we use the Reuters news sentiment filters using our news analytics, we filter that down to 9.9 thousand. But these are much stronger signals. This graph was initially developed for one of our clients that runs a large dark pool exchange in the U.S. that's looking to forecast capacity during the trading day using a pre-market signal. When I first presented this to them, I thought this was a fantastic result. Using our news analytics, we can identify which companies will see big spikes in trading activity at market open. However, during the Sentiment Analytics Conference in London, I was introduced to a new idea by Professor Asher Curtis, which I'll demonstrate in the next slide. Note in the next slide, I'll have to change the left-hand scale of the axis. Rather than minus 120 bips to 120 bips, I'll change it to minus 600 to 600 bips. Here I'm still showing those top red and bottom blue lines in the middle there next to the black line. That was before my strong signal using the Reuters news analytics filters. What I've done in the next two red lines above, or the next two blue lines below, is augment the signals by the level of social media buzz that that company received in the pre-market period from 6 to 9 a.m. And I've done this using the Market Psych product, so I'm coupling our news analytics, news sentiment, Reuters news sentiment, coupling that with the Market Psych indices, social media buzz. Now, since different companies have different levels of social media buzz in the pre-market period on average, I've scaled the pre-market social media buzz by the trailing 21-day average that that company normally sees during that pre-market 6 to 9 a.m. period. So the middle red and middle blue line shows when you have a breaking Reuters news sentiment story and you have higher than normal levels of social media buzz. Now we've doubled the market open. Rather than 100 bips up, we're seeing an average of 200 bips. And rather than getting an 80% increase in trading volume, we're now getting trading volumes that are 3 times the typical volume we would normally see. And this correlates. As I couple that news and pair it with higher and higher levels of social media buzz, we see higher and higher market activity. The very top line, red line, we're getting 400 to 500 bips at market open and 5.7 times the daily volume. And similarly on the bottom line, which is a negative sentiment breaking news story, coupled with extreme levels of social media, 10 times greater than what's typically seen for that company. The big takeaway, and this seed idea came from Professor Asher Curtis, is that social media buzz is a proxy for how much investor attention news is getting. And I want to stress here that I'm not using social media buzz in isolation. And if you attempt to do so in this type of study, you'll just get a noisy signal that's flat, looks like the black line. What I'm doing is coupling higher than levels of social media buzz with breaking Reuters news. And that's key, that what we're using as social media buzz or volume is a window into how much attention that news story is getting in the market, and subsequently what will be the market impact. Now this same idea works during market hours as well. You could do the same thing. Here I'm using it in the pre-market period when there's no exchange information related to prices or volume or trading activity. Now with those preliminaries, I'll move on to the next bullet point, which I'll be looking at identifying behavioral market mispricings over short time horizon, several days to several weeks. There's one strong result I found, and that's using the Market Psych Earnings Forecast Index. Recall that Market Psych produces a number of different indices, not just sentiment and fear, but also indices related to events. So earnings forecast news events, bankruptcy events, merger events, etc. The Earnings Forecast Index is the volume of words and phrases on expectations of improving earnings for a specific company minus the volume of words and phrases on expectations of worsening earnings for a company. Now all the Market Psych indices are buzz weighted across time and across subsource content. So they're all scaled between -1 and 1, or if they're a strictly positive index, between 0 and 1. I removed that scaling by remultiplying back by the buzz, so now I'm getting a total volume of earnings forecast words and phrases specific to that company. If you look at the graph, on a given day, I've looked in the trailing 12 months over my entire universe at that point in time to identify all daily earnings forecast signals. So now I'm looking at the daily time horizon. And over the trailing 12 months, I look at the top form deciles, top decile of signals and bottom decile of signals. And I identify a signal today if it's in either that bottom or top decile over the trailing 12 months. When I get a strong signal today, day zero, I see also contemporaneously a big bump up in price return for that security, and that's the green line I've graphed there. That shows the buy and hold abnormal return from 5 days prior to day zero when I see the signal, the earnings forecast signal. And similarly, when there's a negative earnings forecast signal, there's a big bump down of around 300 bips. Anecdotally, these earnings forecast signals are analyst revisions, upgrades and downgrades, or guidance provided by the company that's being reflected in news. Now, the key difference here between what you get from IBES, analyst revisions, what MarketPsych is providing, is here we're getting a measure of how much media attention those upgrade or downgrade revisions are getting. So we're not using just IBES, which is, say, a bit more objective, what analysts are upgrading or downgrading. We're seeing how the media is reflecting those signals. And as a consequence, we're getting a very strong bump up down at day zero. What's also interesting, and why I'm presenting this, is there's significant post-event abnormal return drift following these signals. So from the positive signals, we see a cumulative return drift of around 50 bips. From the negative earnings forecast signals, we initially see a big drop down on day zero, but then we see a mean reversion effect that drifts back up 40 bips over the following 15 trading days or 3 weeks. In words, what we're observing empirically is an overreaction to negative earnings forecast news, that's the bottom graph, the red line, or an underreaction to positive earnings forecast news, that's the top green line. Now, several months ago, I was at a hedge fund conference here in San Francisco, and there was a presentation by Rafe Giovinazzo, who is with Fuller & Thaler Asset Management, and they look at a number of different behavioral biases, and he showed how they funneled them into two main categories where they see overreaction to negative news or negative events and underreactions to positive events or positive news. Those are the two primary biases that they use in their investment management process. And his primary explanations for why this occurs, for the overreaction, it's due to availability and also loss aversion, well-known behavioral biases. And on the bottom, the underreaction is due to overconfidence and anchoring effects. So his presentation, coupled with these findings, I believe lends some credibility that these are valid empirical results that may be robust. Now, when I saw the presentation by Asher Curtis, he did something around earnings news that's very similar to what I'll do in the next slide. That's quite remarkable. Everything you see on this slide uses only news signals around earnings forecasts. In the next slide, I'm going to add in social media buzz on day zero. So I'm coupling this news signal, positive or negative, and I'll couple that with social media. What I've done is take the same study, but partition it based on the level of social media buzz on day zero. When that earnings forecast news signal breaks, are we seeing high levels of social media buzz for that company or low levels of social media buzz? And how I measure high or low is I look at the daily volume of social media buzz and scale it relative to how much social media buzz that company has seen within the last trailing 21 days. The dashed lines in this graph show when you have a news earnings forecast signal and high social media buzz. What you see is that at day zero, there's initially a very large reaction, but there's very little, if any, post-event return drift. Those dashed lines are flat after day zero. The solid lines, however, when there's low social media buzz, we're seeing less of an initial reaction, still a very significant bump up on or bump down on day zero, but then we're getting much more post-event return drift over the next 3 weeks. Now we're on the order of 80 to 120 bips. I've cited below here the original paper that Professor Curtis presented last year, and he was looking at earnings news, and specifically he was looking at underreactions to earnings announcements and conditioning the post-earnings announcement return drift. Here I'm doing something a little different. I'm looking at earnings forecast news, i.e. analyst revisions, upgrades, and downgrades, and again conditioning it on the level of social media buzz. And I'm making a slightly different conclusion, which is that the behavioral market mispricing that we're observing around these earnings, these analyst revisions, are strongest when there's low investor attention. What's not clear to me is this effect being driven by retail investors, or are institutional investors also contributing to this mispricing effect? Now, if you look at the universe I have listed there in the main graph, it shows S&P 500. There's an important reason why I chose that in presenting you these results, and I'll describe that in the next 2 slides. If I look at the total volume of news and social media, here I'm looking at the total buzz as measured by market cycle indices, splitting it up in the top graph from the large, mid, and small caps, it's clear that the large caps overwhelmingly dominate the news and social media buzz, which is to be expected if anecdotally from looking at U.S. news. Also, if you look in the bottom graph, I've split it up by our TRBC sectors, and you can see that, as expected, the first 4 sectors there, tech, cyclicals, industrials, and financials, overwhelmingly dominate the news relative to the other sectors. Now let me go back to the slide I had up just a minute ago. In this slide, this suggests a non-optimized simple trading strategy, which is when I see a signal on day 0, on the following trading day, day 1, at the close of day 1, buy the security and hold it for 15 trading days. So I've done that over this time period, and I want to demonstrate an effect around the sectors and the overall market. So I'm going to hedge this event-driven trading strategy by taking sector-neutral positions using sector ETFs, and also by making my total portfolio beta-neutral by taking a small position in SPY and adjusting that each day. So these hedged graphs, these cumulative return graphs, you see the 4 ones there from blue to red, those show the returns of this non-optimized hedge strategy that's taken out effects of the market and the sector. If you look at the bottom graph, the blue one, that's Russell 3000. Then as we work up, green is Russell 1000, orange S&P 500, and the very top graph in red is S&P 500 on those top 4 sectors that get the most news and social media buzz: tech, cyclicals, industrials, and financials. And what you see is that performance is monotonically increasing as we move towards universes with increasingly large news and social media buzz. This same effect I see across other signals as well, not just this one, but other research I'm doing, I see the same result. The takeaway being that when we identify a media-driven mispricing signal, we expect it to be strongest over the security universes that typically get large news or social media coverage. i.e., in other words, we don't expect a media-driven mispricing to be strong on a small cap that receives very little media coverage. This is contrary to all the traditional quant factors that I look at, which always have a size effect. So if I'm looking at a traditional value or earnings quality signal, generally results improve as you look to a broad universe that includes small caps. You're getting a size boost there. But here, it's quite the opposite. As we move to the large caps and the high-profile sectors, that's when our media-driven mispricings work the best, which is great because those also tend to be the most liquid securities. Now, the last comment, recently I delivered this presentation at a client visit in London, and they asked about how these signals perform in the UK. So I took the same idea using the market cycle earnings forecast, but looked over FTSE 350, and that's shown in this graph here. This is identical to what I showed 2 slides ago. I'm looking at the news earnings forecast signal from market cycle and conditioning it on the level of social media buzz on day 0. Now, one thing you see I've indicated on the right, both of the lines, whether there's low or high social media buzz, are flat, i.e. we're not seeing any post-event return drift following these earnings forecast signals, i.e. these analyst revisions, upgrades, and downgrades. However, nonetheless, if you look at day 0, first of all, there is a strong market reaction when these new signals occur. So when analyst revisions occur, upgrades and downgrades, we're seeing a big market effect on that same day for those securities. But more importantly, If I condition on the level of social media buzz, we get a significantly distinct market reaction. And you can see that on day 0. If you look at those standard errors and mean bars I've plotted, they're non-overlapping. They're quite far apart, which means there's a high level of significance between those two different phenomena occurring. What this suggests is that social media may be valuable for identifying other types of market mispricings in the UK. In this case, we don't see a market mispricing effect. Everything is priced efficiently at day 0, and there's no systematic bias and no systematic return drift. However, given that significant partition on day 0, there may be use for social media buzz in UK securities to identify other market mispricings. Now I'll move to the next point, relative popularity, and I'll be shifting towards longer time horizons. Here, everything I'll be discussing will be either quarterly or monthly. To motivate this slide, I'm looking now at investment styles. So traditional quant factors or styles such as momentum, value, quality, or profitability. One question that I could ask is there any value to looking at style for a strategic long-term investor? Or should a more traditional asset allocation approach be taken? What's the additional value of diversifying by investment style? Is it just smart beta hype, as I've indicated, or is there some strategic long-term value? The best answer to this question, I believe, comes from this paper in Journal of Portfolio Management by lead author is AQR researcher Antti Ilmanen, who looks at taking strategic portfolios over 20 to 30-year time horizons and first diversifying across asset classes, so equities globally as well as corporate debt globally and government debt and also commodities. But then they go a step further and they say, what if within each asset class we also diversify across different investment styles? And there's 5 primary styles they defined that they've constructed these style premia within all 3 of the asset classes on the left. And they show that by diversifying across these different styles within each asset class, your portfolios have reduced risk. Specifically, you reduce sensitivity or risk to changes in the macro environment. This provides a very tangible benefit to factor diversification within different asset classes for a strategic long-term investor. Now, part of my research goal is to identify to what extent, if any, does news and social media drive style performance. And here I'm looking at longer-term levels, so quarterly or monthly levels. These 2 recent papers with lead author Ibbotson unify the different factors or different ideas of risk or behavioral mispricings in terms of the notion of relative popularity. So rather than debating, is momentum a proxy for an underlying risk, or is it a behavioral herding effect and a mispricing effect, we can couch it all in the context of relative popularity. That's the approach. The proposal that we'll look at in the next slide is measure the firm's specific relative popularity as the quarter-over-quarter change in social media buzz. The idea being that if social media buzz is increasing, this indicates the company is getting more attention. It's probably overvalued. It's getting hyped up more in social media. Vice versa, if the social media buzz is decreasing on a quarter-to-quarter basis, then the company is getting less attention and it's more likely to be undervalued. And what I'll do is take this idea and use it to screen a fundamentals-based value signal. Here I've combined a StarMine, so I work with the StarMine research team that develops fundamentals-based stock selection models. And I've combined the StarMine intrinsic value model, so think PE ratios, and also with earnings quality. This would be a proxy for the Froment-French value and profitability factor. So not only is a company cheap relative to its market value, but also does it demonstrate high earnings quality, accrued earnings, and operating efficiency, etc. The left part of this graph shows if I only use the StarMine fundamentals and I construct future one-quarter portfolios, these are size-neutral portfolios. I've done this within each of the 3 S&P 1500 size group separately and then taken an equal weighted average. How do those portfolios perform on a quarter-to-quarter basis back to 1998? And you can see this nice monotonic, statistically significant relationship where the undervalued companies on the right bin overperform by about 80 bips, and the overvalued ones in the next quarter underperform by about negative 80 bips. Then what I've done on the right in the green is apply the social media screen to screen out. On the right bars, these are the undervalued companies. So if they're increasing in social media buzz, that means they're getting more hype. That conflicts with the fundamentals that tells me this is undervalued. So I'll screen those out. On the left green bars, these are the overvalued companies. If they're getting diminishing social media buzz, that also conflicts with them being overvalued, so I'll screen those out. Now, we don't see a strong boost here. We do see a slight change in the top and bottom quintiles, but it's certainly not significant. Part of the reason may be to the fact that, one, we're going back to 1998, and social media has gained prominence within the last 5 to 6 years. And also, as I've shown you before, the social media buzz is much larger in the large caps, like S&P 500, and plays less of a role in the small and mid caps. So in this slide below, I've done the same idea, but I've done two things. I've restricted to only the large caps that have large social media buzz, and I've restricted to the last 6 years where we've seen large volumes of social media, and we've seen social media gain more prominence, including in financial circles. The left bars, the yellow ones in this bottom graph, show how the fundamentals-based signals perform on the large caps in this 6-year period. We still get the same monotonic relationship, although we don't have statistical significance. We get overlapping standard error bars. The right green shows, now let's apply the screen, the same screen on social media buzz, to the fundamentals value-based signal. And now we're getting a much larger, more dramatic impact on using the social media buzz to condition the fundamental value signal. Now, I'd say this is a preliminary result, a work in progress. A part of the challenge is social media is a relatively new phenomenon. We don't have deep history to test the robustness and significance of these ideas. But I'd like to propose that we can use either news or social media type signals to augment or strengthen fundamentals-based factors. So the value, momentum, etc. And part of my ongoing research is to identify how we might use these news and social media signals, as I'm doing here, by screening on a fundamental value signal. Now, with the last bullet point, everything I've done up till now has been firm specific. I've looked at the social media buzz specific to a company, news sentiment signals specific to a company. In this last point, I'll look at aggregating these signals to the market level to get an overall measure of market sentiment across a universe of companies. In 2014, I published a white paper where I aggregated the news sentiment, Reuters news sentiment signals over S&P 1500 companies point in time. And I did this in a very simple way, a trailing 30-day average over all Reuters articles. And I didn't apply any filters other than filtering out the stock exchange alerts, the imbalance order messages, trading halts, trading resumes, etc. And you can see the sentiment index graphed in the right. Several interesting findings I discussed in the paper. One, at a monthly level, if you exclude the 6-month period in the end of 08 to the beginning of 09 with the market crash, taking out that 6-month period, the correlation, monthly correlation, contemporaneous between market sentiment and market return is almost 0. It's 0.08. So it's quite low, which is surprising. And if you look at the largest month, the month with the largest return, that was October 2011. There was, in that same month, there was huge negative sentiment surrounding the death of Steve Jobs, as well as the Occupy Wall Street protests that were happening. Now, the ideas in the white paper were taken from fairly recent academic research. These aren't my original ideas. But you can use market sentiment to condition post-earnings announcement drift effect, both the accruals and the earnings revisions anomalies, and more surprisingly, how risk is priced in the market based on trailing market sentiment. And I'll add that the academic research I cited used an academic Baker-Werkler index that was populated through 2010, 2011, dating back to 1965. So here I'm not using Baker-Horgler. I'm using the Reuters New Sentiment Index that I've constructed by hand in a very simple way, trailing 30-day average. That last bullet point there, risk pricing, to demonstrate this, I've constructed market beta portfolios and looked at how those portfolios perform in the future months based on the trailing 1 month market sentiment. In blue, I'm showing when the trailing 1 month market sentiment was negative, and in red, I'm showing when that trailing market sentiment was positive. And we get a fairly even partition here between those 2 months. Now, I should add on that point, if you look at the very top right graph, the median level of that sentiment index is very close to 0. I've graphed it with a dotted line. So partitioning on market sentiment in the trailing month being negative or positive, over this time period, we get an exact 50-50 split, 74 months. If you look at the future 1 month abnormal return, you see that following a negative sentiment period, we get this positive risk-return relationship. Following a positive market sentiment period in red, we get that the high beta securities actually underperform. So the high risk or high beta securities are underperforming. The bottom graph shows the same portfolios, but their Sharpe ratios, risk-adjusted return. You can see that on the blue, following negative sentiment, the risk-adjusted return is relatively flat across those portfolios. But in the red bars, we get a monotonically decreasing relationship, i.e., following positive sentiment periods, high market beta underperforms, so high risk underperforms on both a total return basis and a risk-adjusted return basis. Now, what this suggests is that following negative sentiment periods, markets behave as the CAPM model proposes, and CAPM versus low volatility anomaly dispute by dynamically conditioning on trailing market sentiment came from this paper I've cited at the bottom, this 2015 paper, Antonio Ducas and Subramaniam. It's their idea that I've implemented here using our Reuters New Sentiment Index. Now, there's something else I've done. I've taken this idea and I've taken 2 pieces of it and implemented it in a long-only strategy. One thing I've said is I'm not going to time value and momentum. I'm going to time derivatives of value and momentum, i.e., during negative sentiment periods, investors are more risk-averse. We get a CAPM relationship, and they're behaving like value investors, which means subsequently we should expect the accruals anomaly to perform better, i.e., investors are looking for low PE ratio companies, but they're not accounting for the difference between accrued earnings versus cash flow earnings. Also, during positive sentiment periods, investors behave like momentum investors. They're more susceptible to analyst revisions, and here's where we expect to see the earnings revisions anomaly manifested in the following month. So what I'm timing here in this long-only strategy, the graph you see, is dynamically exploit either the accruals anomaly or the earnings revisions anomaly in the future month. And that gives you the red line graph there. It's the second to top line underneath the gold line. I can improve the red line performance by dynamically either hedging my portfolios against market risk or tilting towards the low risk, the low vol securities every month. So that's the second idea I'm using, and that gives me the top gold line. Since I published a white paper in the 15-month out-of-sample period, the strategy has continued to outperform. Part of our news analytics release in this quarter, our version 4.0 release, includes Japanese language news. So I've done the same thing but over a Japanese company universe, a full topics universe, using our Japanese language Reuters news and the Japanese news sentiment scores that we're about to release this quarter. Here we don't have the median equal to 0, it's slightly biased upwards, but I've binned the different sentiment periods into three tertiles: the optimistic in green, the mild in gray in the middle, and the pessimistic red in the bottom. Occasionally, a significant event occurs that affects the entire sentiment index. Either a huge event occurs that will affect the sentiment index. Each of these points contains hundreds or thousands of articles in their company-specific sentiment. But I pointed out that one point there where the Tohoku earthquake and subsequent tsunami hit Japan, and you see there's a big drop in sentiment immediately following that event. One of the research questions I'm looking at is, why does momentum fail in Japanese equities? This has been the one anomaly that's been identified in much research literature, that over long-term periods, momentum works across equity markets and asset classes, but fails in Japanese equities. Following this paper at the bottom, by binning my sentiment periods in these three tertile regimes, I then looked at how does a price momentum portfolio perform during the periods when it's pessimistic sentiment, mild or neutral sentiment, and then optimistic sentiment on the right. Now I want to add here, there's no future-looking signal here. I'm looking contemporaneous, the same month, when the sentiment is either pessimistic, mild, or optimistic. In that same month, how is a price momentum signal performing? And this is a long-term price momentum, 12-month minus 1 month. I've taken this from the Starmine long-term price momentum component of their price momentum model. And you clearly see, in line with the research paper at the bottom, that during pessimistic periods, momentum fails quite spectacularly. During optimistic periods, we're getting a small but statistically significant performance of a momentum factor. Now, what's striking is when I look at extreme periods. So rather than binning into three tertiles, if I've been into 7 or 5, but a higher number of bins, so I'm looking at, say, the top 10 or 15% of sentiment, the very optimistic periods, and the very pessimistic periods on the bottom, I get a dramatically stronger momentum failure during those extreme pessimistic periods. And I want to point out here, this result is robust to excluding 2008 and 2009. I know in 2009 we have a big market reversion. You would expect momentum to fail. It still looks the same if we take out that period. The idea that my current working hypothesis is that momentum failure is very sensitive in Japan in particular to market sentiment. And this is why over long term we see momentum not working in Japanese equities. The only underlying explanation I have for it now is that if you look at Japan over the last few decades, it has been, over the entire world, it's had the largest percentage of population 80-65 plus. And you can see that on the World Bank's publicly available data website. So my hypothesis is that due to the older population in Japan, they tend to be more risk averse. There's less momentum hurting effects. And when the market sentiment's negative, there's a strong risk averse behavior in Japanese markets. Now here, I'd like to point out some future directions. What I've just shown you is macro news sentiment indices looking at or US. I've done the same thing in the UK, etc. Rather than doing a simple average, I could look at how should I filter these companies by particular sector or size, etc., or should I filter to particular types of news? I took all Reuters articles. Perhaps I should be filtering to only earnings news, mergers news, etc. The other point is that now with our News Analytics version 4.0, we're producing document-level sentiment scores over all news, not just corporate news. This includes news on currencies, treasuries, legal news, political news, etc. As an example of what you can do with that, here I've looked at all the Reuters volume on Brexit news. I've classified each Reuters article on Brexit news as either a positive sentiment article or a negative sentiment article based on the overall document level sentiment, i.e., is the author's tone in the article more positive or is it more negative? And here I'm looking at trailing 1 month volumes to slow down these graphs. The red up top shows the trailing 1 month volume of positive sentiment news, Reuters articles that contains the word Brexit in the headline. The blue bars on the bottom show the volume of negative sentiment news that contains the word Brexit in the headline, trailing 1 month. And I've put there a few anecdotal examples. You can see one very positive sentiment story. You can see the document level sentiment is positive. And the bottom, there's a negative sentiment story. Document level sentiment is negative. Clearly, beginning in around February of 2016, we saw a big explosion of news around Brexit. That's been predominantly negative, and that's continuing to increase up through the end of May 2016. My last point, one of the research goals I have, in the last 6 months, we've had unusual interest from large AUM clients. Large funds who are looking to incorporate these behavioral signals, either news and social media, into their discretionary process. And my understanding is that they feel that these signals are gaining importance, and as they mature, they'll become increasingly important for their PMs to use in the discretionary process, so they like to incorporate them now. Several of these clients that are looking at long-term large AUM funds, retirement funds, pension funds, they're looking to do small tilts between, say, market cap weighted versus fundamentally weighted indices. And one of my goals is to, one, identify hypotheses. What's the underlying drivers behind performance of a market cap versus fundamentally weighted index? And secondly, how can I construct a predictive macro news sentiment signal that can be useful for identifying when we should tilt towards market cap weighted indices versus fundamentally weighted indices? That concludes my presentation. Thank you for your time, and I'll turn it back over to the moderator for questions.
Thanks, Elijah. Great presentation. We just take a moment just to see what questions we've got coming in. In the meantime, just to advise that we will be making a recording available of the webinar afterwards. We'll send a link to everybody attending, so if you'd like to listen again or share with your colleagues and friends, you'll be able to do that. Also, Elijah will be coming to London next month. He's going to be presenting at our conference on the 14th and 15th of July, the AI, Machine Learning and Sentiment Analysis Applied to Finance conference, which Thomson Reuters is a platinum sponsor of. So you're able to meet him in person there. I think we've actually just got our first question coming in. Oh, the website, by the way, for the conference is unicom.co.uk. First question we've got coming in is, how applicable are the news and social media signals globally outside of, for example, the US, UK, etc.?
The news analytics English language component and the market psych indices, which scores English language news and social media, are generally relevant in regions or countries where English is the local language. That includes Hong Kong, for example. The Japanese language news analytics we've produced will be relevant in regions where Japanese is the local language, which thus far from my research is restricted to Japan and also South Korea. We don't expect these sentiment products to be applicable in regions where the local language is not English or not Japanese. So I've been challenged by attempting to apply these signals in, say, France or Germany, where the local language is not English. However, these signals work very well in US, UK, South Africa, Japan, and part of our broadening interest, if you look at all of the Reuters news across our feeds, 50% of it is English, 25% is Mandarin Chinese, 15% is Japanese, and the remaining 10% is all the other dozens of language news that we're providing. So there's a huge volume of Chinese language news that we're producing, and we're working now on developing text mining to score that Chinese language news to broaden our news analytics footprint in markets where Chinese is the local language, so a broad subset of the APAC markets. Okay, back to you, Alec.
Thank you. I think we don't seem to have any more questions at the moment. I'm just perhaps give it a moment to see if any more come in, but I think otherwise we've come to the end. So thank you everybody for attending. Thank you, Elijah, for a great, very insightful presentation this afternoon, and hopefully see some of you at the conference next month. Thank you. Goodbye.